Very good afternoon. Welcome back to Bloomberg Markets. I'm Menace Crenny. A quick check on these markets. It's been 4 weeks of decline in the S&P 500. There's been a wholesale reappraisal of risk, hard landing, the response mechanism from the Federal Reserve. We're dipping into the red as we go into the close this Friday. And that's coming off one of the biggest rallies that you've seen since 2022. Bank of America say the data has yet to flip into hard landing zone. UBS say if you get rate cuts and a reasonable growth level, you've got 17% upside in the stocks. NASDAQ down by an eighth of 1%. Of course, this is deeper into correction territory relative to the S&P 500, which has bounced from that near drop of 8.5%. 10-year government bond yields, again, the narrative is here is what is the Fed speak going to be at Jackson Hole? You're going to get CPI next week. Bond yields at 3.93. You've had a 30-point range from this time last week down to 3.66, back up to 3.93 this morning. And this is all coagulating around whether you really believe the yen carry trade has been undone. Just to put it in perspective for you, some of the moves in the S&P 500 really quite dramatic at one juncture across this market. There really was a hefty slide on these markets. This is what else we've got for you. You can see Expedia up by over 10%. They say better than expected second quarter results, but they did warn about a softening in travel demand going through this current quarter, and that could lead to lower expectations for the rest of the year. Roll it over, have a look at Cisco. This was breaking news in the past couple of hours. Stock down 1% now, recovering from its lows. We understand that they're set to lay off thousands of employees, according to a report. That's the second round of layoffs this year. As sales growth slows, Cisco announced 4,000 job cuts back in February. Just think about that in conjunction with your Intel announcement on job cuts there, and you begin to understand the size and the scale of the downsizing to come in tech, the resizing. Let me just use the word resizing. Taking a look at the 7-day chart, as I say to you, puts the whole thing in perspective. It gives you the jobs report last Friday, which is, and that massive paranoia about the unwind of the carry trade from Japan, and that cascaded lower, fed behind the curve, growth scare, a multiple of things which really cascaded into this market on Monday. There's been incremental levels of reprieve as the week has gone on. Let's put it in context. Let's get over to BMO Family Office CIO Carol Schleif. She joins me now. Carol, good to have you with me. I mean, you can see from the drama on that chart, the confluence of negativity on Monday about Interfed meeting, rate cuts along with 150 basis points. That has soothed a little bit because the decision making or the thinking out there is that it may not be just as a hard landing as we had presumed on Monday. You've had 5 days. What's your take as you close out the week?
Well, it's really nice to have a bit calmer Friday and hopefully a calmer weekend than we've had the last few weekends. So that part is reassuring. B, the scenario where you have a negative Friday like you did last Friday and then everyone sits and frets all weekend, that exacerbated some of this because a lot of those issues that the market really grabbed and put together on Monday have been there for a while. And it's also important to remember when you take a step back and look at it that we had very low volatility through much of this market move. And it's not at all uncommon to have markets pull back by 5 to 10%. A lot of times they're spread over a few days instead of such a compressed period. But we were in the camp where we had been building durable portfolios going into this and the ability to ride through this. We'd also been saying we didn't think that we'd had enough volatility in the year, so we wouldn't be surprised to see a 5 or 10% pullback, and that the underlying economy is pretty durable. And as we've seen this week, we've gotten a lot more reassurance on those things, that things are bubbling along at a pretty nice pace across the spectrum, although there's areas to watch.
Yeah, I mean, I think we had that, never was there so much of a sigh of relief breathed over a 1-week jobless claims as I saw yesterday, both in the bond market and in the equity market, which just shows you we're almost like living day to day. David Solomon over at Goldman Sachs said, look, this whole move may even be healthy. I look at the earnings. I was chatting to our earnings team this morning. Earnings in the second quarter were up 12%. So if it's not a hard landing, earnings are reasonable. I've just had JP Morgan with me on real yield talking about a back-to-back 50 basis point cut. If we get anywhere near 100 basis point cut in 2024 and solid earnings, What does that do to the equity market exposure for you?
Well, I think it's important to remember whether or not you get the cut, the market's pricing in those cuts. When you look at where the 10-year has gone and you look at even mortgage rates coming down and you're seeing an uptick in home equity loan applications. So there's stuff in the economy moving, whether or not the Fed moves 25 or 50 basis points in September or beyond that. You've got that piece of it. So I think what it does, though, is that you've got pretty sturdy underneath the economy in general. Mm-hmm. It's also been very nice as we've seen the earnings come in and you start parsing through individual companies. There is that attention to margins. So you're seeing top line growth, but you're also seeing bottom line beats. And those bottom line beats are because companies are going into this strong market we've had and been very careful with what they're doing.
As the week progressed, I think we moved off the base case of deep growth scare and a Fed so deeply behind the curve. And that debate is still there. And I think we'll have a volatile debate between probably now and Jackson Hole, and hopefully we'll get some clarity around Jackson Hole. Laurie Calvasina, along with Michael Hartnett, are both saying, look, the hard landing is not confirmed yet. Laurie was talking about holding this 200-day moving average. And if you move below that on the S&P 500, you're then into growth scare. And you're then in territory, Carol, which can see a much accelerated sell-off, maybe 14, 19% from the highs.
Well, I think it's not unusual to, markets flirt around those 200-day moving averages. They don't necessarily hit precisely. Sometimes when you have the intensity that you had on Friday and Monday, you'll see things in an intense move, daily move like that, things go down a little bit. But it's really an aggregation of the data and an aggregation of what's out there. And we do not suspect that. We still think there's enough underneath this economy to be supportive. Consumers are fraying at the edges, but if we get rates coming down and the rates on those credit cards and hopefully some prices coming down as well, especially as we enter this back to school season, we continue to think that the aggregate of everything, whether or not you briefly touch through violating a 200-day moving average, a piece of it depends on where it settles. A piece of it depends on if it goes through and keeps going, but we don't suspect you'll see that.
How important is fast money flow in this, Carol? And I ask you that because a lot of institutional money had actually already exited a lot of these big tech Mag 7 trades, and they were actually materially underweight that exposure. We were just catching up in retail, weren't we, in terms of July and the repricing? How important is it that perhaps they've revisited that and, in theory, bought that dip?
Well, I think you do have the potential to either repurchase that dip or step back in. The reset that we had was actually pretty constructive and healthy for a continuation of markets. Also, if we did get a bulk of that carry trade unwound, a lot of that carry trade went not only to buying other currencies, but also to buying speculative things and participating more strongly in technology names. So as you started unwinding some of that, we just think the fundamentals of the market as well are in a healthier position now than they were a couple of weeks ago with how bifurcated trades have become.
Okay, Carol, thank you very much. Let's see, do those technicals hold? And you say the nuance is important, whether it's on an intraday basis or a holding. But I think there's going to be a bit of vol between now and Jackson Hole. Carol Schleif there of BMO Family Office, the CIO. As we've been saying, look, it's been a tumultuous week, a tumultuous few weeks for the equity traders and the ETF flows. Emily Grafeo joins me now with the flow show as we have it. Just finishing that conversation there, it's interesting, isn't it, in terms of those who are stoic and those who take opportunities. And you've been looking at some of the flow, and we've been seeing buying this week in terms of the inflows. Just quantify that for us.
We've been seeing net buying. It's nothing crazy here.
Yep.
We're only at about $1 billion net inflows into equity ETFs this week, but you really didn't see that rush to the exits. One ETF that stood out to me was SOXL Soxl. This is an ETF that goes 3x leveraged in index of semiconductor stocks. And it had $1.6 billion of inflows. It was the second best equity ETF for flows all week. So I feel like that's a sign that that speculation is still alive in the market. Those people still want to bid up these names that did really well earlier in the year. That attitude hasn't gone away. Where you saw the outflows, it's kind of obvious. That rotation trade that we were talking about a few weeks ago, it's over now. We saw about $2.5 billion leave a small cap ETF EM and Japan stocks saw outflows as well. And then a lot of trading in VIX ETFs. There was one ETF that goes 2 times the VIX, and obviously on Monday when we saw that big VIX spike, it was up 84%, and then it dropped 40%.
But is this volatility? Is this beginning to? It's beginning to look expensive now. I mean, we've got a whole debate. There's a great story on the Bloomberg terminal at the moment. It's one of the most read. It's about whether the VIX actually made it up to that 65 level or not. But these kind of trades, are they becoming more expensive now? What does the flow tell us in terms of the appetite for protection?
Well, we are seeing traders want more protection as the signs point to an economic slowdown. One example of that is Northwestern Mutual. I spoke to their CIO earlier this week, and he had pointed out that they had bought longer duration bonds earlier in June, and it's actually paid off pretty well. They're up about 3% after buying about $2.7 billion of TLT, which is BlackRock's long bond ETF. And they basically said that they've been waiting for a recession for a long time, as have a lot of people. But they're saying it's coming soon. The next 3 to 6 months, we'll likely see one when you just look at how rapidly the economic data is deteriorating. So they're buying this protection. They're finding this, he called it like an equity hedge in long bonds. So we'll see if it pays off as an equity hedge.
There's a nice risk reward, and I encourage everybody to go and have a read of that, because the risk reward is really quite interesting in terms of a collapse in rates, and they really do quite nicely. But it's obviously not countered with the same viciousness on the upside. And of course, then you've got Steve Mnuchin saying cancel those 20-year bonds. It's an interesting week for markets. Emily, thank you so much for being with us. Coming up on the show, this is what we got for you. Live 360 CEO joins me to discuss the company's first earnings report since going public, right here on Bloomberg. It's your Friday edition of Bloomberg Markets. I'm Manish Krenny in New York. Stock of the hour time, Live 360, the owner of Bluetooth tracking device brand Tile, released its first quarterly earnings report since going public here in the US. The company's shares are now soaring after boosting its consolidated revenue forecast for this year. We have the CEO of Life 360 and co-founder. It is Chris Hulls. Chris, good to have you with me. I mean, great set of results, and the market likes it. You talk about where the next leg of growth is to go, and you focus on international. That's the one thing that caught my eye. Where are you going to grow the most aggressively, let's say, over the back quarter of this year and into 2025? Good afternoon.
Thank you for having me. We're extremely excited about overall growth, as mentioned, and we've been doing this for over 15 years now. And what we're seeing is location sharing is ubiquitous. A lot of the trends that propelled us in the US are now expanding to Europe in particular. People understand that location sharing is a tool. It's not something creepy. Other areas where there's strong driving culture, such as the UK, revenue growing extremely quickly as we launch the full feature set there. So I think we're going to see Europe from a monetization standpoint grow very quickly. And then the rest of the world, MAUs growing everywhere as we've really focused on taking some of these US trends and pushing them throughout the globe. And we're getting a tailwind from more generic services like the ones launched by Apple and Google are getting traction. It actually helps us because we have a very differentiated offering.
I mean, that's what I was curious to know. I mean, you can track the kids, the pets, the Range Rover in the UK. I can only imagine one of your biggest customers are Range Rover customers in the UK. They're the easiest thing to steal. But kids, pets, and seniors and things that we own, what is it that demand is strongest around?
Sure. So today, for monetization, it's families with teens. Our users actually cross all life stages in a way that people are surprised to hear. Teens use it with teens, people with little kids, aging parents. They don't all pay us. Where we monetize as families with teens because we have our driving safety features, automatic crash detection with emergency dispatch, roadside assistance, reports on how your family members are driving at a fraction of the cost of the legacy alternatives. So that is driving most of the growth. But what we get very excited about are some of the things you mentioned. Elder care is not something we monetize today, but seniors are already on our product because they like being on Life 360. They don't like being on devices that make them feel old. Pets is very new with our Tile devices, but soon we'll have a full lineup of GPS-enabled Tile devices where they will be part of our membership tiers with no extra cost. So we think it's going to get people converting more and more across different life stages, which will increase net adds as we improve retention and increase our overall applicability. So very early days for the company.
If I said to you, what's the most valuable piece of data that you can monetize, what is it?
It's not just the data, it's that we have trust and intent. And people come to us for safety. We realize the position we have in people's lives. And because you're coming here for safety, because we have all these different triggers, we know how you drive, we know where you live, we know when you move, when your kid starts a new school, even when you get a new job. Those are things, if we do it appropriately, they're moments of value for customers. Your kid's going to school, welcome back for college, getting a home security system when you move to a new location. These are all areas that we're going to move into that are really untapped and enabled because of the data and user base that we have.
Chris, tell me this. You've been an angel investor. You've been involved in lots of companies. This has been a dramatic week for technology, high drama for markets. When you're the founder and the CEO of a company like yours and your stock takes a smack like it did on Monday, what goes through your mind? What's your worst case scenario when you see that smack?
You know, the honest truth is, with the market turmoil, I did not even look at our share price a single time. I had to do it before earnings because I'm going to be talking to analysts. I'm going to get those questions, but we're in it for the long haul. We have had so many times with COVID where our downloads fell literally 70% overnight. We rebounded quickly. Everyone who bought at the bottom and was patient, they did great. Market downturn, we were quickly able to pivot to generate cash. People who stuck with us did great. So I really ignore the market gyrations. I try to model that behavior for our employees, our investors as well. We really are not taking easy wins. We're in it for the long game. This category is one that can be ubiquitous, and if we continue to execute, we assume the share price will take care of itself over time.
Well, look, you're strong and you have cash on the balance sheet. Are you ready? Are you actively looking for acquisitions? I think you said, look, we will be focused on execution at some point in the future. I will be acquisitive. Is that moment coming closer? And are you in active pursuit of a buy?
We are not in active pursuit right now. We want to finish following through on some of the swings we had taken before the market had its downturn. When we're ready for it, if the share price continues to perform, we will have a very valuable currency. When we think about our strategy, it really is having a dominant position, and we want to be that hub for families. So anything that accelerates plans there, M&A absolutely is a possibility, but nothing is active. I am thinking probably a year from now we'll become more front and center, but we'll cross that bridge when we get there.
Chris, thanks for joining me. That's Chris Hull, CEO and co-founder at Life 360. Coming up in the show, another day, another big media company with another huge write-down on their cable TV networks, right here on Bloomberg. It's Bloomberg Markets with me, Manus Cranny. Paramount stock rebounding after the company took a $6 billion write-down on its cable TV networks. Paramount joined Warner Brothers in taking this step. Yet another sign of a weakness in the traditional TV industry. Hannah Miller joins me around the desk. I mean, it's an interesting reaction function yesterday to Warner Brothers relative to how the market has taken this from Paramount. $6 billion write-down. It's a truth and reconciliation moment that linear TV, traditional format, is under pressure. But what's different today about Paramount?
Yeah, so with Paramount, there's the backdrop of their pending deal with Skydance Media. It's a merger deal. And this is supposed to close in 2025. They're working towards it. Other bidders can submit offers, but there is still a lot of optimism here about how Skydance can transform the business. They've identified $2 billion worth of cost efficiencies.
Yeah, I mean, they are talking about 15% cut in the U.S. workforce. So do you think that's the beginning of a trimming? I mean, you and I sat here and we talked about, look, it is about Skydance. What does Skydance do with Paramount? How do they move Paramount forward? And you said to me, look, this is about Skydance and RedBridge coming together. Just explain to me who RedBridge are. They're the other side of the Skydance deal.
Yeah, so Skydance has partnered with RedBird Capital on this deal, and they're really drilling down here. They're saying you need to tighten the belt, trim the fat. In June, the three co-CEOs of Paramount said that they identified $500 million worth of cost cuts, and that they said on the earnings call yesterday that these layoffs are part of that. So this is really kicking off, a tough time for Paramount. They're going to have to really drill down, identify where they can trim fat, and make a leaner business.
Where is that fat trimming coming from?
So with these traditional TV networks, we're seeing, obviously the streaming platform is being really emphasized here.
The layoffs are targeting various different departments, marketing, communications, technology, legal, a lot of support functions within the company. So it'll be interesting to see who's left at the end of this.
I mean, we saw some good news on the streaming platforms yesterday from Warner Brothers, and their ad revenue on streaming was up, their overall acquisition on streaming was up, and it's a highly competitive environment. So when you look today at Paramount, what's reflected in that story?
So Paramount did see an increase in revenue from its Paramount Plus streaming service.
Yeah.
However, they did lose subscribers. They lost over 2 million people, and that's because of a one-time event. They had a deal end in South Korea, so they lost all of those subscribers.
And yet they raised prices as well, but nowhere near as aggressively as some of the others, isn't it?
That's true. So it was only $1, $2
Yep.
price increase, depending on what tier you had for their plan.
Very different to Disney Plus. I mean, an 8% rise at Paramount versus a 25% rise, let's say, at Disney Plus. Thank you so much for a little bit of context, day one and day two, on the media landscape. Hannah Miller. Markets matter the most. As we go to the close of business on Friday, I can tell you the stock market, off the biggest rally that it had in the S&P 500 since November 2022. You're still going for a fourth week of declines overall. NASDAQ is finding it tough. Again, down ever so slightly this morning. The debate is this. The size and the scale of rate cuts. You've had a narrative here over the past hour that you're going to get 50 basis point back-to-back cuts from the Federal Reserve. That's according to J.P. Morgan. Oil is up by 0.9%. We are on a retaliation watch from Iran to Israel. What will the reaction function be? The size and the scale of the retaliation. The market is on tenterhooks for that. Good afternoon from New York.